everybody in the entire financial world is short upside calls on crypto, right? What that means is the more the price goes up, the more regulation changes, the more they have to get involved. I've seen a setup once like this before, which was the launch of the GSCI Commodities Index back in the late 90s. And basically nobody had commodities in their portfolio. Everybody went to about 5 to 10% weighting, right? The amount of buying was in the hundreds of billions of dollars. The magnitude of what needs to happen here and the fact that everybody's short means that over time, they all get flushed in. And all the... I run one of the many businesses I run is a fund-of-fund business in crypto, investing in digital asset hedge funds. We can see by the performance, most people are underweight. If you look at the equity market in technology stocks, the big players like Cotu, the biggest hedge funds in the world in technology, 75% cash. And then you see on crypto Twitter and FinTwit, people raging about the market going up. They're raging because everybody expects a leg to new lows. It's the story, and Yurian will talk about it, about are earnings going to be taken down? And I've gone back through history. I think the probability is that even if we do have a recession, for some reason, the market's not going to make a new low, because I think once you take the inflation fear off, that helps a lot, because that's the big bogeyman. And the next one is rates. And as rates start coming down, that's the other big bogeyman. And that can really give things traction. And it's a very complicated story in corporate earnings right now, because nominal versus real earnings make things really confusing. So I just have a sense that I did a Twitter poll and 25,000 people answered. And I said, how many of you think there's a new leg lower? 70%. I said, how many of you are underweight? 75%. I'm like, okay, there's no way we can go back to the lows, even though I think the economy goes down the toilet. And the two that stand out to me that were similar in kind of inflation and limited bear markets was 82 and 1990. Those were both massive inflation peaks, but the market only came down 27% in 1982 and 20% in 1990. Yep. Have you thought about why those were different? Because they were both full recessions. ISM went down to 35. Look, I've got a very variant perception here. I think that inflation goes negative in 18 months' time. I think the price of oil comes down to $60. I think everybody's a supply side analyst and nobody understands demand. I think the ISM, which is the driver of the business cycle, or the best kind of monthly indicator of the business cycle, I think it comes down to about 35. So that's a kind of negative 2% GDP print, which I think the markets will ignore for the reasons I said before, and the fact that the euro-dollar market is already pricing cuts for January. I do think that we're talking now at turning point in the cycle, right? And everybody just always looks at where we are today. Inflation's at 8.5%. How can you possibly think the Fed will cut? Well, the Fed have cut every single time in history since 1960, when the ISM has gone through 50. They've either cut or paused. They only paused once, which was 2016. Every single other time they've cut. So they talk a game, but growth leads inflation. I don't buy the structural inflation side of the story for this part of the down cycle. I can consider it for the next bull market and the next economic upcycle if we haven't built more supply in energy and some commodities such as copper. I think oil comes down to $60 anyway. Now, year on year, that's going to give you negative 50% oil price. So the headline CPI is almost impossible to be positive because of the year on year comps. So I think, so to sum it up, bigger, faster recession. I don't think it impacts markets. I think, kind of as Kevin and Yurian think, I actually think markets are fine. I think the bond market does extremely well because it's utterly mispriced. It's the most mispriced of all the other assets. I think the most important point is, if I think of the asset allocation process, right? My view is weaker growth. My view is the Fed come into play, i.e. they stop somewhere set or up. I think the bond market rallies. What do you want to own? You want to own the furthest out duration thing you could possibly own, which is crypto, which is why crypto based exactly around the same time as the market starts picking up that the Fed were going to pivot. So this moment the euro-dollar market starts pricing in cuts, crypto bases. So that's how I think of the portfolio allocation. I love bonds. I think they'll do well. I don't want them for yield. I want them for price appreciation. But the real game in town is going to be crypto, which I don't disagree with Kevin that equities will do well. I just like the risk-adjusted return in bonds. I love bonds because they're easy ways to make money generally. Where are bonds in a year's time? Probably at 1%, okay, in terms of yield. So capital gain is my trade. For yield, forget about it. These guys have so many pension liabilities or hurdles that, as you say, they have to do that. And we'll come into the ETH yield later because it's super interesting for these guys as well. But you're dead right. I mean, bonds really have no value, even in a pension fund, because it'll never close the funding gap, ever, at 3%.
Yeah.
Go back to the 40s, as you and I have talked about several times, there was a period where it traded sideways, and then equities went up 900% because of negative real rates. I look at the trend of 5-year real rates since 2000, they're just trending lower. The average, if you draw a nice average line on it, is negative 1%. We got to plus 50 basis points and broke the economy. I mean, we're fucked. I mean, there's no way we can have positive real rates in this economy. So The reality is, I think negative 1% real rates, as you said, which is fantastic for equities, terrible for fixed income investors. Everybody in the entire financial world is short upside calls on crypto, right? What that means is the more the price goes up, the more regulation changes, the more they have to get involved. I've seen a setup once like this before, which was the launch of the GSCI Commodities Index back in the late 90s. And basically nobody had commodities in their portfolio. Everybody went to about 5 to 10% weighting, right? The amount of buying was in the hundreds of billions of dollars. The magnitude of what needs to happen here and the fact that everybody's short means that over time, they all get flushed in. And all the conversations I have are with the biggest financial institutions on earth, whether it's the sovereign wealth funds, the biggest asset management firms, the biggest family offices, the biggest pension funds. I mean, it's on everybody's radar screen. And incrementally, every bit of news you get that's positive on regulation, or somebody like BlackRock showing the way, or somebody like Texas Teachers showing the way, or somebody like Fidelity showing the way, makes people braver and braver. When you look at what Goldman is doing, JP Morgan's doing, I mean, you're giving confidence to more people. All they need is a bit of price action and they'll be in. I totally agree. The point being is the big pools of capital, whether it's people like Apollo or Blackstone or BlackRock or everybody, sees yield, right? They didn't own gold because it didn't have a yield, and it's difficult for them because they have the hurdle rate we talked about before for so many of their clients. But it's a bigger story than that. It's much bigger than a supply and demand story. What we're actually creating is the benchmark interest rate for Web3. So this is the big daddy of which all risk will get priced against. Everything in the world is Treasuries plus. We have an ability to now price risk. So how does this work? If I look at the Solana staking yield, which is higher than the expected ETH yield, once you adjust it for the volatility of the underlying currency, much as you would do with emerging market bonds, well, they match. So you've got pricing relativity. You can understand what's mispriced, what's not priced, where the risk actually lies. That creates an explosion in DeFi. Because once you have a proper yield curve, that you have and again, I'm going to use the term because people don't fucking understand it, is risk-free rate. The risk-free rate is the fact that the ETH yield will be guaranteed. What won't be guaranteed is the value of ETH. So same with the US dollar. If you buy US dollar bonds and you're a non-US investor, the bond yield will go, the currency will go up and down against you or in your favor. I don't even look at the Bitcoin price anymore. It's ETH. So this whole setup is much larger than anybody expects. If we want to see where DeFi goes, this is the big unlock. It's also the big unlock for institutions. It's the big unlock for pension funds, as long as Kevin said, regulation comes as well. This is a much larger impact than anything that's happened in this space since the launch of stable coins and the launch of Ethereum. That's how big it is to me. But it's not an overnight, you need to buy it now, it's going to go up immediately. I'm talking about structurally, as Kevin said, as regulation eases, as people understand and have clarity, this becomes a monstrous asset for this entire new financial world. Yeah. Well, I'm max long, and I have been, and that has not changed, and I just keep adding. So that's ETH, Bitcoin, a few other tokens. I've got this fund of fund business, so invested in that across digital asset hedge funds to capture some of the alpha of the space. Look, it's getting a little bit overbought. I think if we're getting to trading tactics, whether we get a pullback soon or not, I think we rally into the ETH merge. I think it definitely happens. Whether it happens on the 15th, there's a story coming out that it might come out early. The 19th, it gets out of the way. As Kevin said, that removes some of the uncertainty of the space. Maybe that doesn't happen. There's still a probability that something goes wrong. Then I think it's buy the rumor, sell the fact. It's pretty standard market operation. You buy that pullback with both hands. For what Kevin's saying, for what I'm saying about rates, for what you're saying about network growth, any big pullback you get from here, there's going to be a bunch of people saying, wait for the new lows. I just don't think you wait for new lows. You just use that opportunity. And my view on the tornado cash thing is, I've been saying for a long time, there needs to be a grand compromise between the regulators and the market participants. Gensler is one end. He wants to kill you, take all your money, put you in prison, and then shoot you. The other side is the libertarians from the Bitcoin community who want nobody to ever touch them in any way, in anything they do, right? Those two people have to meet in the middle. And what there is a compromise. And the compromise to reach regulation is stuff like Tornado Cash, whether you agree with it or not, is part of that compromise. They say, we want a bit more control here. We want control over stable coins here. You can do what you want with ETH and Bitcoin over there. And some way we reach something. So this is not going to be the only sacrifice in the game. And we'll fight it and scream about it. Maybe it goes through courts and they can't deem that code can be restricted in this way. But what they're trying to do is draw the lines. And we're all trying to draw the line to the other side. Somewhere we'll reach a reasonable enough compromise that, as Kevin says, allows everybody to operate.